For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Hey, let's manage your financial future. What do you say? Why not? Because we're here. I'm here. Professor Rick Plum is here. Hello, Rick.
Good morning. Good afternoon. Whatever it takes.
Whatever it takes.
When you're listening to this.
Somebody told me they listened to this podcast in the middle of the night on the road. I'm glad it keeps them awake. I was afraid of that. My next line, of course, was going to be, are you sure you want to do that at 2 o'clock in the morning? No, man, I'm driving 2 hours between Denver and something or other. So I said, okay, great. So we're going to have to be lively. We can't get boring. Not that we've ever done that. Anyway, no. Johnny Dean, your podcast host here. We're a little bit different setup for people, for audiophiles who are saying, how come you guys sound a little different today? We're in our remote studios. We're normally together in a studio, but we're going to be doing some of these remotely over the next several months or whatever, until I'm in town or you're in town or whatever it is. So hence the slightly different sound for people who like to notice these things. And we do get emails from people from time to time. Hey, listen, I thought it sounded a little different. Well, this is why. But we're still managing your financial future. And speaking of going out remotely and doing things, Professor Rick Plum,
yes.
You had the opportunity not too long ago. What was that, last week? It was...
a week ago, yes.
A week ago. You were at a conference. How many people were there, by the way?
Well, it was a conference for financial advisors. There were 10,000 advisors, and then a bunch of wholesalers and industry people talking to those advisors. And so what happens is you go and you have big meetings in the morning with everybody, a lot of compliance, things of that nature. And then in the afternoon, there's a lot of what they call breakout sessions. I went to quite a few different breakout sessions. Some of them were on potential tax changes coming up. Some of them, a lot of them offered what we call continuing education, CE credits, which are important for those of us that have licenses and need continuing education to renew those licenses.
Of course, yes.
So that was nice. So there was a lot, and some of them, like what the upcoming election and what it might or might not do to the markets, and what to look for, how this may affect this, how this may affect that. So a lot of, those areas, but a lot of strategy, a lot of different investment products that have been around or are new. So there's a lot of things being introduced. Motivational speakers at times talking about things. A great motivational speaker. I'm sorry, I can't remember the gentleman's name. Former NFL player.
Oh yeah.
It was a very good.
I had his name somewhere. I heard he was great. He had a
very entertaining, very good motivational speaker.
Yeah, some people were asking if they could have a copy of that presentation. If I could find that, I'd heard there was some really good stuff in there. But you had a whole bunch of people, all financial types,
all advisors.
Yeah,
all financial advisors. 10,000
all financial advisors, and this was over the course of a few days. And of course, when you get together with a lot of financial advisors, you have different ideas, and in some cases, you have sort of a group mentality. And I don't want it to sound bad, but Professor, we've of course talk about strategy. There are other advisors that or firms that have a different view on strategy. So let's talk for a moment about some of the talks that you were privy to in this particular conference.
Well, I went to different types of breakout sessions. Like I said, there were some on the future of this and the future of that, but a lot of them had to do also with strategic planning, financial planning, just in general. And like I said, there was 10,000 advisors, but there were a lot of industry people speaking to those advisors about, and I like to go to find out what the industry is talking about, what the industry thinks is important, what the industry is, touting as the next big thing and all that. And it was interesting that there seemed to be almost talking points in several of the different investment-related strategic breakout sessions I went to. And one of the most prevalent was there's a difference between creating and accumulating a net worth and then turning around and creating an investment strategy to distribute take monthly payments or annual payments from that investment net worth.
So
and I was like, this is new.
Wait a minute now.
We've been talking about this for a long time.
How many years now? Of course, we've been saying this, but how long has it taken? I don't want to say the rest of the financial world, but I'm going to say it anyway. The rest of the financial advisory world to determine that your withdrawal strategy needs to be completely different from your accumulation strategy.
Well, they're waking up to it now, and they're actually talking about it.
Wow!
And so, the idea is that when you are accumulating a net worth, time is your friend. Time is your buddy. You have time, and your average rate of return is important. What can I average over 10, 15, 20, 30, 40 years even? Yeah. What is my average? And how I get to that average isn't all that important. Whether I'm up 20%, down 5%, up 5%, up, down, all over the place. It's point A to point B. What have I been able to achieve over time? And so that average helps. Now, the other thing that helps is that volatility I just mentioned, because most of us don't start off with, a couple $1 million to invest when we're 20 and then just let it grow until we're 60 to 65 to retire. We have to build that net worth. So we're usually doing it on some kind of a systematic basis, our 401k or, putting money into our Roth every year. And so that volatility helps us over time because the dollar cost averaging aspect of the volatility given time usually tends to create better rates of return than just, hanging out once in a while and trying to market time. Definitely doesn't work.
Yeah.
So we've got all these things in our favor. And then every one of those things I just mentioned that are in our favor when we're creating wealth, when we turn around and start distributing money from the portfolio, every single one of those hurts us. Time we don't have anymore. The time is I'm taking a check out next week.
Yeah, and you've said before that when you first start out putting money in your 401k, maybe in your 20s or something like that, you actually kind of want the markets to take a dive.
Well, I was actually talking to some younger individuals the other day and saying, look, your goal for the market is that it stays where it is or goes down for the next 10 years while you save and put as much into your 401k as possible so that when it does go up, maybe it goes up 20, 30, 40%, whatever, you actually have some money in it.
Yes.
Because right now, if it goes up 20% now and you just put your first $100 into your 401k, it doesn't help you all that much because you don't have a lot in it. You need to accumulate the shares so that it can then go up with your own shares.
This is counterintuitive, but it's an important point that I want to emphasize here, Rick, because you've heard people say, well, I tried saving for a few months and I just did my account value went down because the markets weren't doing well, and so I gave up.
As long as it's because the markets weren't doing well, you're in good shape.
True. That's true.
If it's going down because you've picked dogs and they're never going to come back, that's a different game.
Well, that's true.
If it's market conditions that have led to it, I mean, what better time to start saving than January of 2000?
Oh, right before the big drop, or 2000.
And keep doing it right through 2008 and 9. Just keep saving.
2000. What was it? 7? Was it March of 2000? When did the 2008 that whole drop happen? It
went sideways in 2007. It was flat for basically 2007, maybe down a percent or two.
Yeah.
It wasn't until later in October, I think it was October of 2008 that it really hit hard. And then it went down until March of 2009. Then March of 2009 it started coming back.
Yeah, so you had time. So in your accumulation strategy, when you're in that phase, as weird as it sounds, you would like to have the markets take a dive. And I'm talking when you're early on investing. I'm not talking about somebody who's starting off when they're in their 50s. That's a whole different story. But
I would say that still works for them because they need to accumulate shares to be able for them to grow.
Yes.
Obviously, you're not looking for dogs. You're not looking for things that go down. But I'm saying the more you can buy on sale, the better ultimately it'll be. If you have enough time. Now, a 50-year-old doesn't obviously have the time of a 30-year-old or a 20-year-old, but a 50-year-old still has time. And if they're just starting at 50, that means they're not going to retire at 52 unless they win the lottery or they inherit a bunch of money. And then the money that they're saving today doesn't mean anything for that, because the money they're saving today, that 50-year-old, is still money that they're not going to spend until they're 65, 70 years old. That's still a 15, 20-year time horizon. So it still works the same way for them. They don't have the 50, 40-year time horizon, but they have a 15-year time horizon, which is still a reasonable time horizon.
Yeah, if you start investing and the markets go up over 6 months, 30% or something like that, but you've only got a few $100s in there, it doesn't help you as much. But if it does go down and you start buying more shares, the more shares you have, the better off, obviously, the increase will be. Now, Professor Plum, so that's the difference between the accumulation strategy. But if this happens, if this same thing happens, the markets take a dive early on in your withdrawal period.
Well, what I was saying was the things that were helping us on building a portfolio: time, long-term average good rate of return, volatility helping us out. Every one of those turns around and says, time is not on our side. We don't have it. Volatility is a death nail to this kind of negative volatility. And the average is, so what if a portfolio did 10% over the past 20 years? If it did it by going down 20, up 30, down 20, that you're going to lose money. You can't. Your rate of return is not decided by the average. Yes. When you're taking money out of a portfolio, because if you're proverbial $1 million portfolio and you take your 4% out and the market drops by 15 or 20%, now you're down 24%. Because you took your 4 and the 20 you lost. The market has to come back 33% or a little more than 33% just to break even where you were at $1 million. So if the next year you take another 4 out, you're not taking 4 of the original, you're taking more like 5 out. And so now it's got to come back 38% to get back to where you started from. And so you're working at a deficit, which comes to the other realization that the industry is coming around to. First one was that there's a difference between the accumulation and the distribution. And the reason the distribution phase is different is because of one of our friends' favorite phrases of all time.
Yes.
Sequence of returns.
That's right.
Initial sequence, the first 5, 6, 8 years, 10 years of the distribution strategy. If your sequence, the sequence being the positive or negative returns each year going forward, if you have a couple of bad years, it can be a complete game changer for the viability of your portfolio. And one of the, I don't have the gentleman's statistics in front of me that he was showing, but he was saying it doesn't have to be the difference of multiple years of downturns. It can be the difference of 6 months that makes a big difference in the ultimate outcome. I mean, just think about if you had started a distribution plan in, January or June of 2008, where the market was down maybe 2%, 3%, versus June of 2009 or March of 2008 versus March of 2009. Completely different results because you're starting from a different area. If I started in March of 2009, my initial sequence was very positive going forward because that's the bottom of the market. If I started in March of 2008, that was still closer to the top before the thing just cratered. And then what do you do with when you have like a 2022 where we'll say, well, my bonds will hold up. Well, in 2022, your bonds didn't hold you up. Everything went south in 2022. So that's, sequence of returns. And there was lots of different, we've talked about it before. When you retire and the future 5 to 10 years from retirement has a big impact. If you're using the old tried and true, or wrong, I should say, systematic withdrawal system where you have a balanced portfolio, you're taking money out every month, every quarter, every year, and then rebalancing to that balanced portfolio. If you have a great series of returns, life is going to be wonderful financially. If you have some negatives, life is going to be trying, and maybe something is going to have to change. You're going to have to change your spending. You're going to change your mental attitude towards things, and it's tough. And it's not just a financial issue, where if the market goes down, I may or may not run out. You've got to be able to control your emotional reaction to that market downturn, and let it ride if you're doing that. But unfortunately, people get afraid and they sell, and we see this all the time where people, we look at the inflows and the outflows of the stock market, money going in, money going out, money going into the bond market, money coming out of the bond market. And the mass population of investors typically are on the wrong side of the transaction, the wrong side of the flow. When the market's at all-time highs, they're pouring money into the market. When the market goes down, a decent amount, 15%, 20% like it did in 2022, money is flowing out of the market. And generally, the flows get bigger moving out of the market just before it turns around.
Yeah.
And we talked about earlier, the best time to buy is when the markets are down. And so that's when you should be going against the flow.
So as you're at this conference, and they've recognized the two things. They've recognized that the investment strategy, your withdrawal strategy, requires a different set of techniques than your accumulation strategy. In fact, it's often the opposite. So they've come to that realization. And they've also said that, well, the sequence of returns is a problem. If you retire, during right before the market drops, this could be a hindrance to the future success. And we know it is.
But you never know that you did that until it's already happened to you.
Okay, so they've acknowledged the existence of this.
And I give them credit for the acknowledgement of the problem and actually identifying where the problems are situated, where the landmines are.
Isn't it great?
It's nice to know.
So they must have come up with a solution, Professor Plum, to this problem, just as we've had this, what we would call a solution over the last 30 plus years that we've been acknowledging this. Professor Plum, is there a solution? What was the one they came up with?
Well, this was in different breakout sessions so there were multiple different breakout sessions talking about these issues. But the solutions were just different ways of dealing with the exact same systematic withdrawal, a different allocation, but still systematically withdrawing from it, or a timing mechanism where when it goes down 10%, you move out of the market. If it goes down 10 more percent, you move more out of the market. And so the more the market goes down, the more you sell out of the market. And then as it goes back up, then you slowly get back into the market. Wait a minute, that doesn't work. It's been shown not to work. So their solutions, at least they're acknowledging the problem, but their solutions, they are clinging to this old, antiquated, outdated, inept, wrong, systematic withdrawal solution, because that's what all of their systems are geared around doing. They can do it with a flip of a switch on a computer. They're trying to get people to buy into their system. They're saying, here's all the problems, and we're going to solve it by doing exactly what we did before with a minor twist.
It's like medical science coming up with, hey, you know what? We recognize symptoms of an illness, and finally we've done the research and all this stuff. So our solution to this is to continue to apply leeches, as we've been doing for the last 300 years. Because
the difference is, instead of putting 3 or 4 leeches on your arm, we're going to put 17 there, and maybe 4 or 5 more on your legs.
More leeches is what we need, obviously. Now, you've identified
we're not talking government here. We don't need more leeches. We don't more government.
Hey now. So, so this is the problem, and they're partway there. And I know because you mentioned this yesterday in a local meeting, and that's how I know that you heard this. And I said,
had a preview of this, huh?
you've got to talk about this, because again, this is something that we've been preaching over and over and over for a long time. Professor, the problem is that they are not doing what, we talked about the need for time, right? When you're accumulating assets, time is on your side. When you're withdrawing assets and you're in your 60s or whatever, however old you happen to be, you have much less time. However, you still can use time to your advantage. And this is where, when we talk about the bucket strategy, this is, I think, where it really begins to shine. Because if you can buy time, and that's the whole point of it, if you can buy time to get yourself through the, you have feast and famine and all that, get yourself through the famines. I read something somewhere that said no investment strategy is worth its salt until it has survived a calamity. Now, I have to agree with this 100%. How many calamities have we seen over the last 30, 40, 50 years? I mean, dozens, right?
But you don't need a mass calamity like the 2000 to 2002 downturn, the 2008 financial reset, the 6-week COVID downturn, the 2022 where everything went down. You don't need massive ones. Unfortunately, even minor non-calamities, but minor downturns if there's a few of them in the first 10 years, can have a dramatic impact on your viability of your portfolio.
Okay.
And people that say, well, and I've had individuals that are getting ready to retire say, well, that's all well and good, but I don't have time. I am retiring in a year. So yes, your time horizon is 1 year, but not for every dollar in your portfolio. You're not going to, if you've got $1 million portfolio, just making numbers up, you're not going to spend all million of them, at least I don't think you are, in the first year. Now, if you do plan on spending all million or all 100% of your portfolio, however large it is,
that's not good.
Yes, then you have a short-term time horizon for that money. But you don't have, most people don't want to spend all of their money in one day or 1 week, 1 year. They say, okay, I need a X amount of dollars per year. So that identifies what monies we need to stay on a short leash. But it also identifies the fact that, if you're spending that 4 or 5%, some of that money you're not going to get to for 15 or 20 years. And so you identify the time horizon. Yes, you have a short-term time horizon between you change your life goal. Some of the money is going to be needed in the first X number of years, first 5, 10 years, 15 years. But some of the money we need to send ahead for when you're 80 years old, 85 years old, or older, hopefully. And so some of the money has a long-term time horizon. Well, what that tells us is we need to identify how much we can afford to put in the market or in the areas that have volatility and leave alone in the market and not expect to take a distribution from it for 10, 15, 20 years. But we also need to identify how much money we need to spend in the shorter time horizons and keep that relatively or very safe. Yeah. That's the whole idea. And don't mix them up. Don't say, well, I've had somebody say, well, when you do your buckets plan, you do your bucket strategy just in general, it seems like about a third of it's in bucket number 1, a third of it's in bucket 2, a third of it's in bucket number 3. Safe money, midterm money, long-term money. Isn't that just a balanced portfolio? And if you look at it as a whole, that is a very well-balanced portfolio, but it's not what we do from that allocation standpoint. It's what we do from where do we take the distribution from. In a typical systematic withdrawal,
it's across the board.
They take it from every one of those sources.
Yeah.
And even if they take it from the cash source in the first year, they rebalance everything the next, at the beginning of the next year, which means they have to refill it, which means they're taking it from all the different sources.
Which means they're probably selling money out of bucket 3, which probably means that if it went down, that you're creating this negative.
Right. So you're not letting the assets do what they were designed to do. Cash is designed for safety and for spending. It's not designed for long-term growth. Long-term growth is designed for that very term, long-term, now, and it should not be short-term.
Now, I got to ask you, when you were at this conference and they were suggesting these, applying more leeches to the problem, and they're coming up and slapping each other on the back saying, good answer there, Richard Dawson. I appreciate that. That's fantastic. Did you at all raise your hand and say, wait a minute now, hold on, I'm Professor Plum. Do you know who I am? Do you have any idea? Do you people have any idea who I am?
We're not going there. And no, I very much resist all those issues. I've had other people nudge me and hit me with elbows and say, Rick, straighten them out. But I'm not going to in that situation.
What happened to you over the years? I mean, years ago, you would have done that. You would have been up on a chair.
A couple of years ago, we were at another conference. It was a good friend of ours who's an advisor here in the firm. And it was the future of Social Security, advanced Social Security strategies. And that intrigues me because I like to know about Social Security.
Of course.
So we went and listened to it, and there was nothing advanced about it. And then there were some questions, and the presenters just couldn't answer any of the questions. And my friend was like, just hit me in the with his elbow. Come on, Rick, give him the answer. At least give them the answer, because they couldn't answer. I'm like, I'm not going to sit here with, and there was maybe 200-300 people in the breakout session. I'm not going to show these people up. And he's like, come on, Rick, they need the answer. Give them the answer. Like,
I would have been right with him, Rick. I would have said, come on, man. I mean, you got a weapon there. You're going to use it, right? I mean, figuratively.
Yeah, but I don't want to use a weapon. I want to be. Anyway,
you want to be nice. You want to be.
I don't want to show anybody up in the middle of a presentation.
I understand, and I'm being fun. I'm having some fun with you here, but
we were at one ethics continuing ed conference, and there was 4 or 5 of us.
Yeah.
And we were not epic, ethics.
Ethics, yes. Yeah.
And we were sitting there, and the presenter's like, "Now, you need to get a team around you. You cannot know everything." And the 3 or 4 people over there, like, "Has he met you, Rick?" Like, shut up, be quiet.
Well, let's have a little contest. Shall we see if we know everything? Well,
I don't.
You don't,
and
I don't. I don't want to say that. But the thing is, here's what I know about you, Professor Plum. That if there's something you don't know, first of all, you'll admit it, and second of all, you will try to correct that immediately.
I will try to find out. If it's important to me, I will try to find out what it is.
You will stop what you're doing, and you will say, "I got to find this out. Something is not right here. Why? What's the answer to this thing?" And then, well, of course,
what's the correct answer, and what are the strategies that around it that we could use to enhance somebody's picture, their financial picture.
But as we're talking about this, though, I don't want to cast aspersions on the entire financial industry because
there's a lot of good people.
While they were kind of doing this whole applying leeches to the problem. The fact is that honestly, if you compare now to even 15 years ago, Professor Plum, the idea of you doing this time segmenting we call buckets has caught on tremendously.
It is starting to become more prevalent. I mean, years back, it was like 20% of advisors are using it. Now 30-40% of advisors are using it.
Yeah.
And so it is becoming a more accepted and understanding the fact that it does help alleviate many of the risk volatility turning to risk problems that we see out there.
Yeah, it doesn't eliminate them, but it can certainly help ameliorate them.
One of the bigger areas that it helps is in the behavioral finance standpoint.
Yes, keeping you from doing the wrong thing just because you're scared.
And that is one of the biggest impacts I believe that it can have because, as we mentioned earlier, people do the wrong thing for the wrong time. They get into the markets when it's at all-time highs. They get out of the market when it's at lows or on the way down, which is the exact opposite of how you should be investing in the market. The market is not a short-term speculation area for most people. It's something that you use to your advantage over time.
Yeah.
And you need to let that work for you. You got to give it the time to work.
Well, and you think about why people do that. Why do they flee when the market is going down? Now, some just don't want to see negative numbers, and that's one side. But to me, when I see people fleeing and jumping out of stocks, it's because they're concerned that they're saying, I need that money. That's money I'm going to need next year, next month, 2 years, even 5 years from now. I want to protect that money. And where the bucket strategy helps, that we've talked about so often this year, it's almost been like a story arc this year, where it helps so much is somebody says, well, look, I do see that the market is going down. But you know what? It hasn't affected my income. This is not money I need for a while. No matter what the market's doing. And I know
that I have the cash flow that I need for the next X number of years. So this is not an immediate threat to me. This is a future threat, and the future has time to recover.
Yeah. In fact, I would almost argue that it's not a future threat so much as it is sort of a potential. I don't want to call it even a threat because 20 years from now, what the market does today is almost irrelevant, in my opinion.
Right. At least that's the way it always has been.
Well, yeah. But I mean, 2008, as bad as that was, as bad as it was in 2008, by 2012, I mean, it was mostly not forgotten, but certainly irrelevant.
And like I said, what was the best time to be an investor?
Yes,
not a seller.
Yes,
that was the time to get in.
Oh, it was
the first quarter of 2009 when everybody was, and all the news reports were negative. Everybody was talking about how we're going to heck in a handbasket. That was the time to get in. Now, I had a friend who changed it. Luckily, he had a spouse that worked, and he could live off their salary instead of his. He changed his 401k to be 100% of his paycheck in January of 2009. He wanted to max out his 401k. I can't remember what the limits were back in 2009, but lower than now, as soon as he could. Yeah. And so he was putting, each month, it was like went down. January, February.
But you know what?
But then it turned around, and he had a lot more money in it when it came back.
You know what I picture when you're accumulating shares as it's going down? I picture Lewis and Billy Ray collecting, yes, I'll take that. Thank you. Yes. All right. I'll take yours. Thank you. Oh, yeah. Give me that. Yeah. You know that scene, right? When they're,
right, towards the end of their trading session.
Yes, exactly. Which was
trading places.
Which was a totally improbable. It wouldn't happen in real life. But if you've seen Trading Places, you know which scene I'm talking about. That's what you should be doing when the markets are going down. When everybody else is panicking, you can say, sure, I'll take that. Thank you. I'll take that. Thank you.
They were selling at the high and buying at the low. That's what they were doing.
Isn't that the first thing they teach you in investing school? If there is an investing school, I don't know.
Yeah, buy low and sell high.
That's what you're supposed to do. I mean, that's the idea. And if you're doing the opposite of that, I think you're only going to hurt yourself. So, Professor, I wanted you to talk about this, and I appreciate that because, you didn't have a chance to, you didn't want to respond to it at the conference itself. But when you had a talk locally here among our advisors at Lucia Capital Group, you had a chance to respond and say, this was wrong. This doesn't work. And so I wanted to give you another outlet here on the podcast to talk about that.
I was giving credit for acknowledging what the problems with retirement investing are. The fact that the old rules of accumulation don't work, allocation and diversification only works so much. But they've acknowledged it. Now they just have to open their eyes a little bit more to different solutions. But like I said before, their systems are designed around that systematic withdrawal. Until they can change their systems, they're going to keep trying to push, If you're a hammer salesman, everybody looks like a nail. So if you're a systematic withdrawal salesperson, everything's going to look like some form of systematic withdrawal.
Which is why you want to talk to somebody at Lucia Capital Group, because you've been doing this bucket strategy thing for these many years, 30 some odd years now. I think you've got it down. I would say.
I've done it for a little while. Yeah.
If you want to talk about working toward surviving the calamities, the feast, the famine, and saying, you know what, if my cash flow, my income is not affected by what's going on in the market, I'm perfectly fine with that. Give them a call at Lucia Capital Group, 800-644-1150. Professor Rick Plum is the Chief Financial Planning Officer. And I didn't say you're a certified financial planner professional. I didn't say that at the top. And you're an accredited wealth management advisor.
Yes.
Yes.
I am.
And only because I've kept that cheat sheet. All this laminated cheat sheet all this time. But I should do that. And I think it's helpful to have somebody with an accreditation like that, Professor Plum, certainly a certified financial planner professional who understands how these things work. It's good to have somebody who's working with that, and you have that as well. I'm going to give you credit as well, Professor, once again for not doing what the younger professor would have done, which is stand up and say, you're wrong. Let me tell you why you're wrong. Because I've seen you do it. It's not pretty. I've seen you do it.
But I was right.
I know you were right. That's the problem. You can't refute it. It's just you were right. And I'm glad you said that, because
with age.
you have, which is good and not so good, but it's probably helpful. 800-644-1150, the number again at Lucia Capital Group. Give Professor Rick Plum or any of the Lucia Capital Group advisors a call. They can help you out and certainly get you, I would think, on the right path. At least take a look at what you've got and say, hey, am I on the right track? Can some things be tweaked a little bit? Oh, and by the way, I'm concerned that at some point the markets are going to go down, because that's what they've always done. I'm a little concerned that the day I retire, it could take a dive of 20, 30%. It has happened before. So I would appreciate it if you could design a strategy that can at least help me get through those. And that's the whole idea behind buckets. Talk to them, 800-644-1150. Also go online at luciacap.com. I was on there today. Boy, we got a lot of resources on there. luciacap.com. And you can download. We still have the Social Security Guide up there. Professor, you talked about that. Social Security Guide. We've got a retirement guide. We've also got an estate planning guide. And we're working on a few others, I'm told. We'll find out. I can't say for sure because I don't know exactly when they're going to get done. But I think 401ks was on the horizon. Don't quote me on that, but I do believe so. LuciaCap.com. Find out resources. We've got video and all that great stuff, things to read. What else? Is that it? It's been a while since I've done these. Yeah, for now. Okay. I appreciate you, Professor Plum. And we're doing these remote broadcasts. And technically, I think it worked. I'm going to find out. If somehow this podcast doesn't make it on the air, it's because the technical details weren't worked out. But I do believe we did that. Hey, it's nice to see you again. It really is. I mean,
it's been a little while.
We record these quite some time in advance, several weeks in advance. And with all your traveling and my traveling and all this stuff during the late summer months.
I haven't seen you for many weeks.
I know. It's been a long time, but I appreciate this. And say hi to everybody for me, would you?
I will.
All right. Hey, we thank you all for listening. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much, and we will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice. It is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. An asset allocation strategy does not ensure a profit or protect against loss. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The people mentioned in this presentation are not affiliated with or endorsed by LPL Financial or Lucia Capital Group.